Ladies and gentlemen, I'm Paul Mullins, and on behalf of Kallanish, I'd like to say a big welcome to our scrap and iron ore markets webinar for the month of August. So I've got two colleagues who will be giving their thoughts on their respective markets. We'll start with Tomas Gutierrez, our Asian editor, who will focus on the iron ore and some of the new highs that we're hitting in China. And then our Turkish editor, Burcak, Alpman, based in Istanbul, will give us an overview of what's happening in the scrap market. I'll now hand over to Tomas, who's going to talk us through the highs of the iron ore market in China. Tomas, over to you.
Thanks, Paul. Yeah, so my presentation today is called Iron Ore Hits New Highs Again. The reason is I was going to call it Iron Ore Hits New Highs, and then I realized that's what I called it last month. So only a minor change needed this time. So if I take you all back to last month, if you remember, those of you who joined, we ran a poll to see where people thought prices would be heading towards the end of the year. There was a slight win for those people who expected a decline in prices after around a quarter, prices to remain firm for around a quarter, followed by prices remaining firm for about a month. And in last place were people who expected prices to remain high all year. That was obviously based on the expectation of demand in the autumn and whether prices would be sustained by that demand, especially that demand in China. Since last month's webinar, however, we've obviously seen two very sharp increases in prices, one at the start of the month, and then another just in the last couple of days. And we're now seeing prices approaching $130 a ton for 62% Fe fines. So I think at this point, this is a good opportunity to run a new poll and see what people think going forward, and then I'll explain our view.
Thank you, Tomas. So the question is, where do you see 62% Fe iron ore prices in 1 month's time? And we have 5 options, and here we go.
Okay, thanks, Paul. So this time we have a pretty clear winner. We have $125 to $135 a ton at 38%. So that is essentially prices within a $5 range of where they are now. We then have also 26% predicting a decline, so $115 to $125 a ton, and 20% predicting another increase to $135 to $145 a ton. And this is interesting in that it really reflects expectations for, on the one hand, Chinese demand, and on the other hand, is iron ore really trading at a fair level, or is it overpriced? If we go back to the slides now, so if we look at our view for the market going forward, we've replaced our 3 previous scenarios with 3 new scenarios to see in general trends where things are likely to go. So we have 2 variables really. One is demand over the autumn, and one is what happens at the end of the year. At the end of the year, we're looking to see how sentiment is supported in terms of the Chinese economy. There's a lot of issues around the sustainability of financing, but also there's a general optimism about the economy overall, that it is recovering and the demand should be strong, and that balance will play out in the 4th quarter. But before that, we have this issue around the coming months. Obviously, China is expected to go into a period of strong demand, and our base case is that that should support prices moving higher than where they are even at today's elevated levels, but only a little higher. So really we're looking at that range of 130 to 140 maximum we expect, but we will see. And obviously the market has surprised us fairly regularly this year. The other possibility, of course, is that markets find that iron ore really is overvalued, and if demand disappoints or fails to meet the very high expectations in the coming week, then obviously there's a possibility that prices will decline marginally, but the actual improvement in demand should prevent any real collapse in prices. So we're looking at fairly high iron ore prices going forward. Looking back slightly over the last month, it's interesting the prices have gone so high, partly because the expectations a month ago were that supply would recover and the Chinese demand would weaken a little. So what actually happened was that supply did recover and Chinese demand did weaken a little. So if we look at that, here we have Chinese iron ore imports, which in July were at very high levels again, and another steady increase. May, June, July, as volumes have increased pretty steadily. In terms of Brazilian iron ore exports, which obviously were an issue earlier in the year, there has been an increase in Brazilian iron ore exports. Again, you see July picking up to the highest level of the year. So the supply side really, for the most part, did behave as expected. Australian volumes were not as strong, partly because of the end of the first half reporting period. But nevertheless, that didn't impact supply overall. So iron ore supply was fairly firm. And if we look at Chinese steel demand here, then again, there was a very clear decline in steel demand through the summer. So from the record high levels of May, we saw demand decline in June and then decline again in July. That decline in demand was real and it was felt in the market. Prices have remained fairly firm, but steel prices did go through a period of volatility and a little bit of weakness for a couple of weeks. And so that slowdown in demand has been felt very clearly, even though Q2 demand has, as we said before, already wiped out the loss of demand in Q1. So H1 and January to July demand is up year on year. But nevertheless, we saw a situation with slower steel demand and higher iron ore supply. So what's really been pushing the prices higher? One factor has been the expectations for Chinese demand in the coming weeks, which have really dominated steel and iron ore markets. Another is the tight portside market for key products. And finally, the fact that China is essentially still very hungry for different kinds of iron units, not only for iron ore, but also a lot of imports for DRI and pig iron. Before we move to the next slide, I'd just like to say one thing on the portside market. There's a couple of things that have happened. One is the delayed licensing for imports of all commodities from Australia. That increase in the licensing period to 11 days, it has a small but probably meaningful impact on the market. So if you're shipping iron ore from Australia to China and you have your fixed port and you don't have to change the port, you probably have time to sort out your licenses without any issue. But the issue comes then if you need to switch ports, if you require any flexibility in that license, then obviously you face a situation where you may have to take a cost because of that delay in terms of your ship not actually being able to unload at your second choice port, for example. That has helped partly the issue around the portside market being tight for particular products. In particular, at the moment, you're looking at kind of medium grade and low grade fines products, which have supported the market. Obviously, at the moment, we're looking at a period where steelmaking margins are very, very tight again because of the high iron ore prices. Normally, that would be pushing mills to choose lower cost ores, but a low availability of that means that prices are nevertheless sustained. So the ability of mills to reduce costs is being restricted. The bigger picture, however, is really around Chinese steel demand. And so the expectations for demand in the autumn, and in particular starting in September, is for construction activity, infrastructure investment, all to ramp up fairly steadily. So here, this is one of the underlying reasons for that. The net flow of government bonds. This is local government bonds issued by the provincial governments. And this is funds essentially that has been raised, and you can see a spike in the last 3 months. That money is in place, but the actual construction and the real kind of steel intensive work on those projects will pick up over the next few weeks. And so that money is, or a lot of that money is waiting to be spent in the next few weeks. And that has obviously driven optimism about steel demand over that period. At the same time, you have inventories, which have also been supportive. Now, even though you saw in the graph previously that Chinese steel demand has declined steadily through June and into July, that did not generate a very strong response in inventories. So we had high production imports, and we still had inventory levels only increasing marginally. So this is just the week-on-week change in inventory levels. And you can see after the spike at the start of the year, obviously with the lockdown, there was a very sudden movement in inventories. But over July and August, there was an increase in inventories, but it was not very dramatic. And that obviously means that the market's in a fairly tight situation going into a period of higher demand. And we can't really pass the month without noting that China has now officially become a net steel importer. It's another indication of how tight the market is and the fact that production levels are being sustained at very high levels, and it's still not enough to supply the market. So you can see here net imports for the first time since 2009, and that is expected to continue. If we have strong steel demand in the coming 2 months, then net steel imports are also likely to continue for that period. And that obviously is related not only to steel, but also for alternative iron units. So in addition to iron ore imports, which are also at very high levels, steel imports, which are now net imports for the first time since 2009, China is also importing a lot more pig iron, and it's importing a lot more DRI. The one thing it is not importing more of course, is ferrous scrap, and that is because of restrictions on the imports of ferrous scrap. Now, that is something that might change next year, but it's currently not expected to change in the short term. So China is really relying on DRI and pig iron, for which there are obviously lower volumes available, and imports of iron ore to sustain very high blast furnace utilization. So that demand for iron ore is continuing, and the inability to import scrap is contributing to that, because it's one less alternative to iron ore that China could be buying to boost its production. So China is obviously very dominant, but there's obviously a lot going on outside of China as well. And in terms of iron ore, there are a few things that the market needs to be aware of. Blast furnace closures outside of China have been very significant. Some countries affected more than others. Korea, for example, has been less affected. Gwangyang blast furnace number 3 restarted in July, so blast furnace production in Korea is actually fairly firm. In Japan, however, which this chart shows, hot metal production has obviously declined very dramatically, led by the closure of blast furnaces. Those blast furnaces are obviously primarily at Nippon Steel, but also at JFE, and Kobe Steel, which is not idle blast furnaces, has reduced utilization significantly. So there's a question over what happens to those blast furnaces going forward. And in Japan, the issue is really colored by the fact that this isn't just a problem around the coronavirus. This is a long-term problem for Japan. Japan was already going to be entering a recession even before the impact of COVID, and is already in a process of restructuring. In the long term, in particular, Nippon Steel is working on making its capacity layout much more efficient. So we see a situation where there's many blast furnaces shuttered. Some could restart, some may never restart, and some will restart but later. So we don't expect more than 1 blast furnace restart before the end of this year. So a very limited potential for increased demand from Japan this year. We see at least 2 of those blast furnaces in Nippon Steel probably never restarting. And then there are some blast furnaces which are still in question. So, for example, at Wakayama, there's a blast furnace which is due to be closed down in any case in 2022. Whether or not demand is strong in Japan next year will determine whether that blast furnace restarts before then or if it never restarts. Outside of Japan, there's also a pickup in India. Indian demand is now recovering slightly, partly an easing of the situation, but also mainly seasonally because of the end of the monsoon. That is likely to mean higher production in India, but then of course the Indian impact on seaborne markets is reduced because of its local options to source iron ore. So what are we looking at going forward? We do expect demand to improve in terms of steel demand in the coming weeks, and that should support markets. That's likely to mean that Chinese crude steel output will be back at record highs shortly. That means strong hot metal output as well and strong steel demand. And so really on the demand side, there's very little to suggest that the iron ore market will drop away. What we would want to raise is that later in the year, we think the outlook is slightly more uncertain. China's economic policy is being very closely defined, and the level of credit put into the economy is also being very closely controlled. So currently we're seeing a lot of stimulus, but there's also a lot of desire to pull back on that. So we remain slightly less optimistic about the end of the year. I'm going to leave it there, but please do ask us questions, and I'll be back during the question and answer session. Thanks very much.
Thank you very much, Thomas. Bang on time as well, so well done for respecting your allocation. What we'll do now, we'll move over to Burcak in Istanbul, who's going to talk us through what's happening in the scrap price arena, and give us her perspective on not only where we are now, but also why we are where we are now and where we can expect to move in the near future. Burcak, over to you.
Thank you, Paul. Thank you for the introduction. Good afternoon, ladies and gentlemen. I'll give you latest information on Turkey's scrap market and short-term outlook, as Paul just said. Hope you enjoy it. Starting with some statistics from this year, in the first half of 2020, Turkey maintained its position as the 8th biggest crude steel producer in the world, with 16.3 million metric tons, down 4.1% compared to the same period of 2019. Production contracted in all regions in the first half, with the exception of China, Iran, Vietnam, and Egypt. Total steel production capacity in Turkey is approximately 52 million tons. In the first quarter, however, Turkey was one of the sole countries that recorded production increases, as COVID-19 hit Turkey mostly in the second quarter. Steel scrap consumption thus declined in all countries in the first quarter of this year, except for Turkey, which has increased its scrap consumption by 13.4%. China, however, was still the largest scrap consumer in the world, with 41.5 million tons in the first quarter, and this underlines its position as the world's largest steel scrap consumer. Among the total of 16.3 million metric tons of production in the first half, electric arc furnace production appeared at 10.9 million tons, while blast furnace production was at 5.4 million tons, down 4.3% and 3.7% on year, respectively. This has caused electric arc furnace steel production share to decrease to 67% from 67.8% last year in overall production, but could not prevent Turkey's steel production from being dependent on scrap. Domestic scrap share among Turkey's scrap consumption in the first quarter was only 28.3% with 2.1 million tons. This fell from the average of 32.6% last year. Turkey, with domestic supply only below 30%, is the world's foremost steel scrap importer. Turkey imported 9.7 million tons of steel scrap in the first half of this year. During this period, Turkey's scrap imports increased 7.8% on year, despite the 4.1% decrease seen in crude steel production. Turkey sourced 63% of its scrap imports from the EU, 20% from the US, and 10% from CIS in the first half. On country basis, however, the US was the largest supplier with 1.96 million tons. It was followed by the Netherlands with 1.37 million tons and the UK with 955,000 tons. This chart shows the price trend of Turkish imported scrap in 2020. It is based on daily price changes and represents Baltic and US origin HMS 80/20. Before examining which factors have been effective on imported scrap prices recently, we have a small poll where we want to see what you think about current scrap prices at 285 CFR Turkey right now.
Thank you, Burcak. So the question is, how do you see the current HMS 80/20 scrap price level in Turkey? As a reminder, it's currently at $285 per ton CFR.
Okay, thanks for voting. I can see that 47 of our attendees find the levels healthy, and I must say that I agree with them. Only 25% of our attendees find the current levels low. Okay, let's examine what happened in scrap and rebar market so far in Turkey. Thank you. So, what happened in Turkey's scrap market since May this year? Although Turkish mills have exerted pressure on scrap prices due to squeezed scrap and rebar margin in May, they have failed to decrease scrap prices at desired levels due to very tight scrap supply arising from COVID-19. Turkish mills with very low levels of scrap inventories have increased their scrap demand in mid-May, and scrap prices started climbing with the support of China, which has increased demand for semi-finished and finished steel. After mid-June, however, with the respite they got with scrap purchases, Turkish mills slowed their demand. Coupled with the recovery seen in scrap supply following the ease of coronavirus measures, scrap prices started softening. After the first week of July, the sharp increase seen in iron ore prices returned confidence in Chinese market, and Turkey's obvious need for August shipment scrap purchases caused scrap suppliers to increase their offer prices. As scrap prices fell sharply in the US in July trading, most US suppliers have directed their cargoes to Turkey. Despite the availability of scrap, high demand from Asia and Turkey has caused US suppliers to increase their prices. European scrap prices, meanwhile, have also risen due to increasing euro-dollar exchange rate and high DAC prices. As a result, supported by the strong demand, scrap prices have increased to 285 CFR in Turkey until the second week of August. Since last week, however, Turkish mills who have seen that they are unable to sell rebars with current scrap costs are halting their scrap demand. Although there are many suppliers with offers in the market, Turkey shows no interest in scrap purchases while focusing on finished steel sales. So, how was the situation with rebars? Rebar demand contracted in all regions due to the pandemic. Turkish mills, however, were forced to reflect scrap price increases in rebar prices as their margins did not allow otherwise. Towards the end of May, however, Turkish steelmakers have seen significant increase in their domestic market after Turkish government announced new incentives for housing sales, such as delayed and long-term payments and lower interest rates for buyers. Meanwhile, China's demand for semi-finished and finished steel increased significantly. Turkey has achieved to sell large tonnage rebar cargoes to Hong Kong and the US in May. After mid-June, however, with the softening seen in scrap prices, buyers' expectations for rebar price drops caused them to halt their rebar purchases, and rebar demand slowed in the export markets. Domestic market demand, however, maintained its strength. After the first week of July, increasing scrap prices, strong domestic rebar demand, Chinese demand for imports caused Turkish mills to increase their rebar quotes. For the first time, rebar prices have returned to pre-pandemic levels. However, buyers in the global market have found rebar prices high and resisted prices at $450 FOB. Turkish mills have been unable to conclude export sales at targeted tonnages recently and have been forced to decrease their quotes this week. On the other hand, fast depreciation of the lira, raising interest rates, the cancellation of some incentives given by the government, fast increase in the number of COVID-19 infections caused mills' trust in domestic market to be damaged. And we are facing slower demand in Turkish domestic market this week. Current offer prices in the domestic and export markets stand at $445 ex-works and $440 FOB right now. This graph here shows the trend of HMS 8020 CFR Turkish scrap and Turkish rebar FOB prices since 2015. As you can see, although the margin tightens and widens time to time, most of the time prices follow similar trends due to Turkish dependence on imported scrap. Between 2015 and January 2020, average margin between scrap and rebar appeared at $174.2 with high fluctuations, as you can see on the graph. The red line here shows the average margin, which is $174.2, while the blue line refers to the average cost. We consider $160 as the average rebar production cost from scrap with a very rough calculation. Although the margin has hit $142, which is the lowest since March 2017, in January and in May this year, it has then recovered. Scrap prices have risen by $30 since the beginning of July. Turkish mills, however, have increased their rebar export prices by more than $30 during this period with the support of domestic market. As a result, the margin has increased up to $165 US dollars last week. However, following the decreases seen in rebar prices this week, margin has once again dropped to $155 below average cost. This graph here demonstrates the cost of rebars from billet versus scrap. Assuming billet is at $415 CFR Turkey and scrap is at 285 CFR Turkey, producing rebars from billets is more advantageous versus producing from scrap today. Indeed, most of the time, producing from billets is more advantageous, as you can see on this chart. Today, there is a difference of $9 between producing from scrap and billet, with billet having the advantage. So before sharing our outlook with you, we would like to see where you see the prices in the coming period. Here comes the second poll question.
Thank you, Burcak. So I'll just read this out. Where do you see the CFR Turkish scrap price level in September?
Thanks for voting again. So most of our attendees, 41% of our attendees expect prices appear at 260 to 80 levels. We are, I can see that our attendees expect prices to remain firm in the near future. Continuing with our outlook, before getting into details with our outlook, we wanted to share some news that may affect Turkish scrap market directly or indirectly in the future. US dollar Turkish lira exchange rate, which has followed a sideways trend in June and July, has sharply increased in the beginning of August. A dollar equivalent of Turkish lira increased from 6.84 to 7.38 only in a few days. Sharp fluctuations in the exchange rates caused buyers to follow a cautious stance. The euro-dollar parity has also been showing a steady increase recently and has approached almost 120 levels. Turkish finished steel consumption increased 8.7% in the first half of 2020, despite the significant fall in April and May due to the pandemic. However, finished steel production grew less quickly, showing that imports are taking a larger share. Turkish Steel Producers Association says that the extraordinary increase in June imports clearly shows imports need to be reviewed immediately, as Turkey's approach is unsustainable in the current conditions and calls for immediate actions. Turkey's first half long and flat steel consumption increased 12.4% and 5.8% respectively on year. Turkish long and flat steel production, however, increased 3.3% and 0.9% respectively, while total finished steel production increased 2.3%. The association aims to meet domestic steel consumption through domestic production. Turkey has fulfilled first-term quotas for most products in the EU. According to the European Commission data, the 3-month quotas applied on construction steel, railway material, and hollow sections were filled before the end of the first month. Furthermore, over 90% of quotas for products such as organic coated plates, profiles, and wire rod were filled at end July. Turkey has even completed the sales of certain products that will be shipped for the second-term quotas. EU real steel consumption fell 5.8% on year in Q1 to 38.6 million tons after a 8.1% drop in Q4 2019. Eurofer expects apparent consumption to fall 16.6% in 2020 and then to rebound by 14% in 2021. Construction output, however, is forecasted to contract less at 5.3% in 2020 and rebound by 4% in 2021. Vietnam's steel industry is expected to benefit from the EU-Vietnam Free Trade Agreement implemented from August 1st. The EU has accounted for only slightly over 4% of Vietnam's annual steel export value in recent years. Vietnam steel products are facing the risk that the export market will be further narrowed due to several trade remedy investigations and the imposition of anti-dumping duties. On the other hand, the EU has restricted imports from many countries. Following the agreement, many steel producers in Vietnam are making efforts to improve product quality, to change the direction and promote exports to the European market. Canada may be facing the threat of US tariffs on steel in addition to aluminium. Trump announced his administration plans to reimpose a 10% tariff on some Canadian aluminium imports as of August 16, hitting its trade partner just weeks after the North American trade agreement went into effect. Turkey ups exports of steel to US more than half this year. if the US imposes tax against Canadian imports, Turkey could have a chance to further increase steel sales to the US. The Latin American Steel Producers Association, ISRO, has expressed concern over the regional steel sector facing an increase in unfair trade. It warns of a continued increase in imports, specifically from China, and says it is seeking measures together with governments to protect local mills from low-priced imports. This could be a threat for Turkey, as Latin America is an important export destination for Turkish long steel products. And our outlook for semi and finished steel markets. We are facing more protectionist measures each day due to the contraction seen and expected in global steel demand in 2020. As a result, global steel demand is expected to remain depressed. Turkish Steel Producers Association expects the decrease seen in Turkish steel exports in the first half to accelerate in the coming months due to European quotas having already been filled by Turkish exporters for some products. Although Turkish steelmakers are expected to be more active in export markets due to the fast depreciation of the lira now, they will likely fail in succeeding this. With demand remaining limited and competition being tough, we are expecting buyers' pressure on steel prices to continue. Turkish domestic demand is expected to lose its strength as Turkish government has cancelled some of the incentives given in June. On the other hand, fast-spreading virus, increasing interest rates, and high fluctuations seen in the currencies cause buyers to follow a cautious stance. Although domestic market is still outperforming exports, most market players express concern over the risk that domestic market fundamentals are not solid. Instead of being a threat, China continues taking advantage of low prices and concludes purchases from the global market. CISA said that Chinese demand in the second half will exceed first half. Strong Chinese domestic demand is expected to keep cheap Chinese steel from depressing export destinations. China's steel demand is strong after the rainy season, as Tomas has given the details. So steel demand in China is expected to remain strong in the near term, as investment data shows infrastructure investment is continuing to recover ahead of the expected autumn spurt for construction activities. But we still have the risk of the virus, which is fast spreading all around the world again. Possible lockdowns and restrictions will likely interrupt business. And our outlook for scrap. With the end of the holidays and summer heat, we expect scrap flow to accelerate in the EU and main supplier countries. In the US, capacity utilization rate has barely reached 61.5%. It was 7.79% last year at these days. We are expecting a surplus in global scrap supply as demand is expected to remain limited due to lower capacity utilization rates arising from the foreseen contraction in steel production. As Turkey has been unsuccessful in selling rebars at desired quantities and at current levels in the global market, Turkish mills are seen to be exerting pressure on scrap prices while halting their purchases. As September shipment deep sea purchases have not been fully completed, they are expected to return to the market but continue exerting pressure on scrap prices. Scrap prices in the US are expected to edge up with September trading. Following the sharp fall in July, the US scrap market has recovered in August, but not yet seen the significant increases registered in export markets. Most market participants are, however, bullish and expect prices to rise with September trading, even in the Midwest, where the recovery has remained limited compared to South and Southeast. Shredded scrap prices are expected to go up by $30 in the Midwest. Bullish sentiment in the futures market and rising trend in finished steel prices are encouraging Chinese producers to produce more. Iron ore price, which has reached its highest level since July 2019, is expected to remain firm in the near future. Chinese crude steel and finished steel production increased 9.1% and 9.9% on year respectively in July. There are a lot of projects that have been pumped with financing, which will be in active construction over the autumn. Optimism about autumn demand and new injections of liquidity to the economy are driving prices higher, while prices are expected to remain firm for another while. Domestic scrap demand in the EU has recovered last week unexpectedly, despite the ongoing holidays, while supply has decreased due to the holidays and summer heat. We are expecting to see stronger scrap demand once the holidays are completely over. And that is our prediction for the coming days for scrap prices in Turkey. We expect scrap prices to soften because there are a lot of suppliers in the market that want to sell their material. On the other hand, Turkey has seen that with current scrap costs, they are unable to sell rebars in the global market. So they are expected to exert further pressure on the prices. And however, once they start or increase their demand for October shipment cargoes, the market is expected to recover again, because we are expecting European demand to recover, US prices to increase, and there is the sentiment is quite bullish in the international markets. That was the end of my presentation. Thanks for listening.
Thank you very much, Burcak and Tomas, of course. Tomas, if you'd like to turn your screen back on, so join us. We've received quite a few questions during this presentation. These presentations. So I'm going to jump in now and start going through some of them. First one is, Burcak, how do you see rebar demands will come from Middle East countries for Turkish products?
Middle Eastern countries have decreased their imports from Turkey significantly in recent years. So although we are expecting better market conditions in the Middle East with the current restrictions we have in the market, we are not expecting a significant increase in Turkish exports to the Middle East.
Okay, thank you. Nice and succinct. Tomas, there's one for you here. It's a slightly longer question. It says, would it be possible to clarify why the Chinese plants are buying higher iron ore grades such as Fe65 comparing to the recent history, and shall this behavior be continued?
Yeah, I mean, right now I think the issue is really of what's available. So there is a shortage, or at least a relative shortage of lower grade fines at Chinese ports, and that has made 65% more attractive to Chinese mills. Also, I think it's really driven by ultimately by this need for Chinese mills to buy in whatever they can. They want to keep production high, and they will pay a premium for 65%, but they will they will buy all ores. And so really those proportions aren't necessarily decided so much by the mills currently as by availability and how Chinese mills can just maximize production.
Thank you very much. There's a related question from a different member of the audience, which is, I understand China demands for iron ore, but still China alone cannot make the price of iron ore increase, especially with current low demand of other regions in the world. So the question is, why did the price of iron ore reach this extremely high number?
Yeah, well, I mean, one of the issues is the way that iron ore is priced. Iron ore is really priced off the trade to China. So China does have a larger impact than anybody else. If you think of, firstly, China is 50% of steel production, but on top of that, it's reliant on imports, whereas it isn't for other products. And so it's around 60, it's around 2/3 of the seaborne import market, and that proportion currently is obviously higher because of the weak demand elsewhere. So changes in China do have an outsized effect. But there are obviously other issues going on, as well as specific tight markets for particular products, especially the medium grade fines, which obviously plays into the index prices.
Thank you, Mr. Gutierrez. Burcak, a different question for you, so a really simple one. What is the effect of the euro-US dollar parity on scrap price?
Europeans will have to increase their prices because their costs will increase in dollar terms. So we will have higher European prices in Turkish market, in Turkish scrap market. So which means one of the biggest players will not be able to offer the prices that Turkey expects.
Thank you. And this one's for you as well, Burcak. Steel billets, really succinct. Steel billets, CIS price predictions for September, October.
Oh, actually, billet prices most of the time follow scrap prices in Turkey because Turkey is a big importer of CIS billets. For the moment, there is a pressure on scrap prices, but also there is pressure on billet prices. And Kardemir last week has opened sales below the expected prices. So the Turkish market players were really confused about the prices. So now they're exerting pressure on billet prices as well. But there is demand from China for billets, so it's not the same thing. So China buys a lot of billets from CIS. So I cannot say scrap and billet prices will follow the same trends in the near future. But I cannot tell you about the exact price.
Understood, thank you. I assume you'll be writing about this in the near future. One for Thomas, somebody who's asked two questions. We've got a lot of questions, by the way, so I'll get through as many as I can. Those that we can't answer now, we'll put together some comments from Burcak and Tomas, and we'll distribute them to you by email within the next few days. This question for you, Tomas, is what are, according to you, the key factors to see iron ore remaining firm or even going higher, picking up further?
I think obviously we've talked a lot about Chinese demand. So Chinese demand increasing as expected in the next few weeks will be essential, especially if you're talking about prices going higher. The other possible impact would be if there's another serious outbreak of COVID or any other disruption to supply in Brazil or Australia, then obviously that could be an outlying risk going forward. If that does happen, then of course you could get another spike in prices.
Got it, thank you. And then there's a second question from the same person, which is for you, Tomas, still. Pellets and lumps are quite low in premium and stocks in harbour appear high. How long do you think this will remain?
Yeah, there has been an imbalance in Chinese port stocks and really a shortage of fines, and that there is an excess of pellet and lump, and there have been moves by some traders to grind down pellets into fines, which obviously in the big picture doesn't make sense. And so the issue there is that the premiums have fallen to the point where it can be profitable to sell the product as fines. There's issues around the capacity to do that. There's not grinding capacity set up to grind all of that that material into fines. And obviously, I mean, if you think about it, there's logically something not right in a market that supports that, and so at some point that will change. But really, the issue at the moment is the market's so tight that may only change when Chinese steel demand falls off and mills' buying habits perhaps return to some normality. So I wouldn't expect a sudden change in that situation until later in the year.
Understood. Thank you very much. Burcak, a question for you. To Burcak, please. What happens if we have a second wave of the pandemic? How will it impact scrap collecting and price?
It will affect scrap collecting directly, of course, because with the restrictions and the lockdowns, the scrap collection activities will be interrupted. So we will see a significant slowdown in the flow, and this will most probably increase the prices. But on the other hand, as we have seen during the first wave of the virus, the producers may also decrease production at some levels. So this will also decrease the demand of scrap. But it is we'll see how balanced the situation will be, but both demand and supply of scrap will be seriously affected if the second wave of the virus hits the markets.
Thank you. A new question, this one for Tomas, most logically. Do you think that the low price of coking coal is supporting iron ore buying activities in China?
To a certain extent. I mean, it certainly moderates the cost of a blast furnace operating in China. Obviously, there's you have high iron ore but low coking coal, then that helps. But really, if you look at what's happening in China and what's driving that iron ore price, Chinese blast furnaces are competing, I guess, more theoretically more against Chinese electric arc furnaces. So I would say that the price of coking coal is an offsetting factor, but it's actually the price of scrap that's really supporting iron ore. And by that, I mean the price of scrap within China and the cost of a Chinese EAF as opposed to an EAF outside of China. So it's really still around that ban on scrap imports that remains the key issue there.
Understood. In fact, somebody's raised a question on that, which I was going to come to, which is for both of you really, but when China does allow the import of ferrous scrap, what impact will that have on the scrap market generally, but also Turkey in particular? Firstly, go to you. We'll stick with you, Tomas, for now.
Yeah, so on the Chinese side, there's a lot of lobbying still for this change to take place. There's a lot of expectations that it could be passed maybe at the end of Q1 next year or Q2 next year. And the expectation is that, as it's difficult to know exactly what price levels will be at that point, but if scrap is attractive, China will buy in large volumes. And that will obviously cause a pretty significant disruption to markets in China and outside of China for scrap. So the expectation would be very sudden disruption when that takes place, but also then the markets would have to find a new level where China and Turkey compete on an almost equal basis in terms of purchasing imported scrap.
Thank you. And Burcak, your thoughts from the Turkish perspective?
Well, Turkey is the largest importer of scrap, and China is the largest consumer. So if China starts importing at high quantities, it will most probably affect the flow of the scrap, or the direction of the scrap. So we will most probably see higher prices because the biggest competitor will be in the market and buying huge tonnages. So it will affect scrap pricing, and Turkey will most probably see higher prices on scrap.
Thank you. I'm conscious of the fact that we pretty much used up the hour that we allocated, but we've still got a few questions. There's one related to scrap here, which has just come in, which is there's a temporary ban imposed in South Africa on scrap exports, brackets, a major exporter and provider of scrap. This is suggested to be followed by an export tax. How will this affect scrap prices and in particular scrap export prices?
I'm not expecting to see a huge effect because it's not a significant exporter country, even with the taxes. So it is European Union's attitude is important here because there were rumors of possible restrictions for scrap exports. That would affect the pricing huge, but you know, from south, I'm not expecting a huge difference in the market scrap prices. Yeah.
If I can just add to that, I think that's absolutely right in terms of the international market, but it's interesting from our webinar last week, the Asian Steel Markets Focus one, where Rajit Mangal, CEO of Tata Steel Thailand, was also talking about a possible increase in scrap protectionism and markets which are generating sufficient scrap, limiting exports. So I think it's quite right that really in terms of the big markets, and I think especially when it comes to Turkey, you know, you'd have to have shutdowns in Europe or the US to impact that international price. But you could see smaller markets, national markets like Thailand or South Africa, you know, protecting scrap and having then a more fragmented market. So you have national markets with a slightly different price level, and that could be interesting going forward.
Thank you, Thomas. We'll do one quick final question and then we'll call it a day, which is, sorry, it's just because I'm getting more questions coming in, so it's scrolling up my screen. Thomas, do you expect some new blue sky policy or air control measures to interfere with the current booming steel production in China as winter comes back?
I think there will still be policies in place this winter. There will be some impact on production, but those policies in any case are already moving to a slightly different phase. So China has these ultra low emission standards, and most mills are expected to have, I mean legally expected to have met that standard by this winter. Mills that do meet those standards, according to regulations as they stand now, will not be restricted. So there probably will be mills that are restricted, but and there may be a decline in production, and there may also be a decline in production simply because demand is weaker in the fourth quarter. But we won't see a sudden sharp reduction in production due to policy in the way that we have seen, you know, 2-3 years ago. That's unlikely to happen again.
Thank you. So it'll be very much focused on or restricted by tiers of mills, A, B, C.
Yes, but more and more mills should be in A. Yeah.
Perfect. With that, we will close this webinar. I'd like to thank you all for joining us and for staying with us through the presentations and also the questions. I'd like to thank everybody who participated in the polls and also those of you who submitted questions. We really appreciate it. Next week on Wednesday, we have our Global Steel Markets webinar, which will have a panel of probably 4 of my colleagues talking about what's happening in their respective regions. So again, it's free to join, so please feel free to register for that and tell your colleagues and any of your contacts in the industry. I think that's all that remains for me to say, other than say thank you very much to Burcak. Thank you, Tomas.
Thank you.
Once again, thanks to all of you for attending and for your participation, and wish you luck. Hopefully see you on one of our forthcoming webinars, and please stay safe. Thank you very much and goodbye.